Give a little shameless plug to the content on our website. If you are new to trading, or even if you are a member and you just haven't gone over here yet, there's some really great content that not only helps get you in the right direction, but it solves a lot of your problems. I was talking with a trader yesterday, and he's kind of new to the community. You could tell, if you're around long enough, you see familiar names and faces. And this person is just constantly struggling. Every day you can see in the questions that they're asking that they're just constantly struggling. And when I answered one of his questions with a statement that basically went something like, I've done videos on that and it's in the next level library. Their response was, yeah, well, maybe someday I'll get around to doing that. But for now, I'm just not going to do it. I'm not going to put out the money to get access to that next level library. And I totally get it. This stuff, it's not free. You got to pay for it. And yet, that person who's struggling, their struggle would end because I have the answers to their struggle right here in these videos. So, little shameless plug, right? Commercial's over. Go ahead and bring in the rest of the crowd. All right. Good morning. Good morning, everybody. 5 things you need to know. Apparently, Goldman Sachs and Citigroup says it's time to buy the dip. Well, I'm glad they let us know, huh? Yeah, right. Just thought I'd point that out there. Tesla's got some delivery numbers and a couple other things on the Tesla side worth looking at. This is Bloomberg's 5 things you need to know. So you can get it. It's a free email. They'll just send it to you every morning. On the docket for today, of course, we got the Fed thing in the afternoon. But before we get there, we've got some inventory numbers and home sales. We do have some earnings, and there's going to be some response from Microsoft yesterday. And of course, we got Apple coming up, Tesla coming up. So we got quite a bit on the agenda. I named this morning the catalyst for a number of reasons. It really does seem like this market is waiting for an excuse. Markets kind of rallied a bit last night in the overnight hours. We're kind of fading off a little bit now, but so on the docket today, we're going to look at FX Street. It's how we start the morning. FX Street provides a little bit of perspective on the dollar. You can see that we have some highly anticipated impact coming in, right? When we have these economic events, um, we want to know, what do they normally do to the market? Do they typically cause volatility or not? And FX Street provides that perspective with these light and dark colored boxes. So we've got quite a few this morning. Just be very careful, guys. I can't stress it enough. Um, this time, I have not been hearing the certainty that we were hearing last time, and so that makes me feel a little bit better. I really start to get nervous when I hear those pundits on TV and Bloomberg and places like that saying things like they know, right? Well, we know they're going to raise rates. We know they're going to do. They don't know nothing, right? We don't know. They don't know. It's all speculation. The concern is when too many places out there start saying, "Oh yeah, we know," then we start getting too many traders on one side. And you want to know what happens when the market is off sides? You can see it when we get these big catalyst spikes after a news event. Right? That usually happens when too many traders were off sides. So when we don't hear that kind of language, then it's a little bit better. We have been seeing a pricing in of the market for these rate hikes, and the anticipation that it's all going to start in March. It's supposed to be 25 points. So there's a number of places today during the meeting this afternoon, the presentation, whatever you want to call it, this afternoon, where he could pop a lot of bubbles where people have this idea of what they think the Fed is going to do. At the end of the day, it's going to be Operation Don't Rock the Boat. And of course, he's not going to be able to do that this time. He has to provide some kind of forward guidance. If he can do that with clarity, we should see some amazing results right away. If he does it with a lot of ambiguity, then of course we won't exactly see results right away because they'll have to call the nerds and say, what did he mean? What are we supposed to do? 8:30, 10 o'clock, 10:30, 11:30. Got quite a bit on the agenda. And of course, then the 2:30. That doesn't mean we can't trade. There are plenty of opportunities. And pay attention to your institutional pivot points today. Give you an example of yesterday's reaction to an institutional pivot point and why they're so special. Now, this isn't a one-off. It's not like a one-time thing that this happened once and makes it worthwhile. This is where it had closed on Monday. We had that nice little rally yesterday afternoon, and it hit that thing like a brick wall. This is the SPX. This is yesterday's close. We call it an institutional pivot point or a universal pivot point. It's a universal pivot point because nobody can argue with you. Yesterday's low is yesterday's low. Doesn't matter what chart you're looking at. Doesn't matter what time frame you're looking at. Yesterday's low is yesterday's low. It's inarguable. It's a universal pivot point. Same with Globex high, Globex low, yesterday's high, low, close. All of those are institutional or universal pivot points. Mark them on your chart every day so that when price is moving towards one of them, you know you can see it. It doesn't mean that we're going to hit it and stop every single time, but it does mean that we're very likely to see a reaction in price when we get there. You could anticipate that reaction in price. So we had a really decent move yesterday. That symmetrical breakout on the ES, the wedge breakout on the Dow, a really nice follow through, textbook perfect. The only thing that was wrong with it is it happened a little too late in the day. So the fact that it failed wasn't really too much of a surprise. I was actually working with a group of traders yesterday and we were discussing this and the fact that it was breaking out late. And we actually called the fact that it was more than likely going to fail. And sure enough, it did that. It's always nice to see that the work that you've been putting in to study patterns and setups and opportunities follows through and kind of validates the work that you've been doing. So for today, we really want to see us hold above that pivot. That's yesterday's highest value, unless you want to count the Globex. And there's nothing wrong with counting the Globex. The only argument there is when do we start counting it? Think or swim starts to shade at 6 o'clock or 1600, 4 o'clock. The market technically closes at 5 o'clock and then opens up at 6 o'clock. So depending on where you wanted to mark the close and where the new open is, this point that we marked actually tagged the highest point of the Globex. So that really is the high of yesterday, not this. So we want to see that maintain. It's very likely not going to as we get into the morning session. We're still going to be in the same boat that we were in the last 2 days. We're expecting the market to maintain that range as we wait for the Fed. Now, Microsoft, the fact that Microsoft did not dump is a really good deal. But if you noticed, it didn't exactly take off like a mad demon to the upside either, right? And it had a $40 expected move for earnings. That's $40 higher and or $40 lower than its closing price yesterday. We didn't get any of that, right? We've seen an $18 drop to the downside and it took it all back up again. Tesla and Apple now have an even higher bar to beat. This is one of the most critical weeks of the entire year. So if you're not yet in a trade for your longer term swing trades, let this play out. I started this discussing the fact that Goldman and JP Morgan says it's time to buy the dip. I keep this little list right here when it's time to call a bottom and look to start buying the dip. Take a look at the 10-year. I look at the VIX. I look at some dip buying already beginning to happen on higher than average volume. And then I look for a surge in call options buying. Now, we don't have all four of those done on the checklist yet, but it's pretty close. This does not take into account anything like the Fed or announcements, economic events, earnings, just conditions for calling a bottom, right? So uh, we're expecting this to hold into the afternoon, get our guidance from the Fed, and take it from there. So for today, I really expect that we're going to maintain the range. You can expand that range a little bit, perhaps something like 44.5 and 42. Just like I've talked about before, start with a very narrow range. Think about it in zones, right? So zone one could be from this pivot low to the current Globex high. You can expand that by taking it from our own Globex low to Globex high. You can expand that again by going even farther from yesterday's lowest point to the highest point on the Globex of yesterday. It's three different tier groups, three different zones. And then beyond that, we would be looking to mark from the low of Monday to the high of Friday Globex or Sunday Globex. And that would be yet another zone. By doing this, you can quantify what you consider tradable activity because it's very likely if we are inside of our own price action, then that's not going to be a very tradable opportunity. And I say that, and yet there was this really amazing, really beautiful price action yesterday when we came out of that wedge. So obviously, there is plenty of trading inside of a Globex range that can be very nice. But technically speaking, most of the time when we're in a situation like this, where we are trading inside of our own Globex, it's going to be a day that looks like what's inside that wedge. Choppy, nasty, difficult for new traders to trade. I know traders that don't even go to the computer on Fed days. They just stay away and go do something else. Not necessarily a bad idea. I don't want to capitulate that way and just not participate. I always think there's something to do. There's something to trade, something to look forward to. So we're in the NASDAQ here. Really notice this compression before the move. I mean, that really impressed me. The NASDAQ is a rangy little bugger. And during that zone right there, it really just tightened up the reins. It's a big screaming neon flashing light warning sign, megaphones, a Vegas style, watch out, it's about to do something. Well, it did it. So we have an inside day breakout. If you consider just the RTH session, the NASDAQ is outside of that range, but we're still inside of yesterday's entire day. Right? We're going to be looking to maintain this range, either staying inside of yesterday's range or seeing a catalyst event earlier today and getting outside of yesterday's range. I don't really see it that we're going to make it though. I think this market really wants to wait on the Fed. I say that, but anything can happen. News can come out. We do have other economic activities today that can propel us in a catalyst, right? So be aware of that. We were talking about percentages yesterday in the group on the indexes. And outside of these extreme conditions, a 1% move in the market is a pretty normal move in the market. If you're looking for like a good bearish day, a good bullish day, a 1% move fits that really well. Now, we've been in a high volatility market, so we're seeing moves well beyond that 1% move, right? We got an ADR right now of almost 2%. But generally speaking, a good, clean, bullish day in the indexes is about a 1% move. We're already up this morning a 1.8%, right? So, which means we could fall back 1.8% to flat, fall back to being back to where we started last night, and it wouldn't even be considered extreme. The market wouldn't consider that negative. So imagine falling back down from our current location 300 points and the market wouldn't even shrug, right? So remember when we go to Market Watch, you got the economic events here. The press conference is at 2:30. And if you don't have Thinkorswim, then just like I start every day with this briefing, go to FX Street. It's free. You can Google it. It's got an FX calendar and it will show you the anticipated impact of each of these economic events. Notice the confirmation that we had in the VIX yesterday and that crazy move in the bonds and the dollar. We actually talked about this as well, about the impact or influence that the bonds and the dollar have on the market, and then taking that away at 3 o'clock when they close, right? Because they close an hour early, which is often why our power hour gives us such surprises, right? If these two markets are influencing our market and then they close and that influence is suddenly gone, it's where we often see a change in sentiment in our own marketplace, those crazy moves in the last hour of the market. Well, where do you think that comes from? A lot of times it comes from these two closing at 3 o'clock. Now, we were talking about the symmetrical wedge on the ES and the flat wedge on the Dow. But notice the Russell had the same symmetrical wedge, right? So if you heard me talk about the ES, you heard me talk about the Russell because it's the same one. Look at the same pattern, the same setup, the same follow through. The only difference is the Russell actually maintained better on that pullback than the Nasdaq and the S&P and the Dow did. The Dow had that flat top, the Nasdaq had the flat bottom. These are three different triangle setups yesterday, and all three of them are great to trade. The one that we were discussing was the one that was on the Dow. It's one of my favorites, half-day wedge breakout. I love this trade. But the time that it breaks out is really important. So if you're trading these on the indexes, watch the clock. If it happens too late in the day, it's very likely going to fail. If it happens too early in the day, it's very likely going to fail. Got an inverse head and shoulder on the dollar this morning, getting a little bit of a move, but keep in mind we're still maintaining the range, and the bonds are still maintaining the range from yesterday. So we had a significant move, and then it all just collapsed back down, and we're right back where we started. And it's what I've been saying for 2 days. Expect a whole lot of running around, a whole lot of violence, and at the end of the day, we're like the hamster on the wheel, right back where we started. That we're not expecting this market to really do anything until the Fed. That doesn't mean we can't trade. You can see there's plenty of movement. We're just not really getting anywhere. All right, so what we want to be looking for is a lot of red to greens. We had the market going down into the close yesterday afternoon. That provides the red candle. The red to greens is a daily setup, so we're looking for a red candle yesterday, a green candle this morning, gapping up in the pre-market higher than the open of yesterday's open. I know that it sounds crazy, right? You got to kind of slow down and say it a little easier. Like, wait, what'd you just say? What? Red to green. We want a red candle yesterday, a green candle today. We want to gap up in the pre-market higher than the open of yesterday's open. So we're going to look at liquid options. Companies with liquid options from December, right? We'll use that for our line in the sand. What you're going to want to do is look at the closing price yesterday, look for some red candles. Take like Microsoft, except that's an earnings, so we're going to leave that one alone. So Google closed in the lower portion of that red candle. In the pre-market this morning, you're going to want to see a rally up at least as high as yesterday's opening price or higher. And the reason I say or higher is because then you can use that institutional pivot point for support. When the market opens, we want to see it fade down, hit that support for our entry opportunities, break out of yesterday's highest point, which gives us an inside day breakout on a red to green, and then we target structures on the left side. You should at least be able to get a 2% move or 1% after the open, right? So don't count where we left yesterday because that could be 2% right there, and we haven't even got outside of the candle yet. Target your strikes for the options that you're trading 1% past wherever we open. Red to green setup is a really great trade opportunity. Days like yesterday are perfect for it. It's just a catalyst play. Right? We're not talking about swing trading long term, anything like that. It's just a catalyst play. Red to green setup. Now, a lot of people like this. It's not really my jam. It's fine. It's okay. But we have a green day yesterday, gap up in the pre-market, and then we expect another green day today. Yeah. I mean, obviously it happens. It shows up, but that's not the one I want. Right. So you kind of go through your watch list in the morning. You put together your list of names. Start looking for a daily signal in that list of names that you have. Inside day breakout, IX10, wedge, inside day, trendline breakover. Something on that list from the daily time frame that gives you a little more confluence so that you can narrow down the list of stocks that are on your list. So looking at names that have weekly options that were traded the most in December, that's where this December liquidity list comes from. We can see a lot of names this morning that are up more than a half of a percent. A half of a percent is the benchmark starting point for the entire day, right? If I'm looking at a list of stocks that I want to put together in the pre-market, they need to at least be up a half of a percent. If we look at the sectors this morning, how many are up, how many are down, which ones are down, so we can see that the marijuana sector is down slightly. As we go over and take a look at that. A lot of names on the list that are up, so that ETF, the MJ ETF, is a perfect example of why those ETFs leave a lot to be desired when we're using them for sectors. Utilities, emerging markets. Now, this is the ETF that we use to kind of gauge global participation. If the global money is feeling risk on, risk off, those situations, we see it in the EM. So when the global marketplace is bullish, we see the EM up in the pre-market. When the global markets are skittish, scared, uh, risked, then you'll see the EM down. We need either the financials or we need technology to see a good move in the marketplace. When we have both, the move that we expect to see is even larger. And you can see that we got XLF, which is the financials, and we've got the QQQs, it's technology, or XLK, also technology. All of those up this morning. Now, energy and finance has been tightly correlated for the past year. So, seeing finance up like that, we want to take a look at energy too. Make sure that it's doing what we would expect it to do. Everything is looking really positive. Even precious metals are up this morning. But be very careful about this, right? We've got the catalyst today. We know that this market is going to maintain that range. Let me rephrase that. We're very confident that the market's going to maintain that range. We don't know, right? We don't know. Nah. If you look at the names on the weekly options list, this is a very long list of names, and they are all green. One way to be able to quantify that, and it's usually I've been using this for what it provides this way. This is TradingView, and we come in and set that heat map to pre-market change percent. And we use the filter because this is 500 names. We don't want to look at 500 names. We want to knock it down to around 100 names. That's not always easy to do. 94 is close enough. We'll set it there. Now we want to adjust the color scheme from a 1.0 to a 0.10. That way it's more responsive. We don't see so many gray boxes. Green on the screen. We are risk on. Now, there are sectors that aren't doing so good. So, if you're looking for an opportunity, maybe watching health would be a good way to go. Otherwise, look at every single sector and every single peer group is looking really solid. Now, this is just the S&P modified to be close to 100 names. Well, let's look at the NASDAQ 100. So we want to set this to pre-market change percent. We don't need a filter. We can adjust the color scheme a little bit in here. Health technology is a little weak. Consumer services, consumer non-durables. The difference between the NASDAQ 100 and our modified S&P is that the NASDAQ 100 does not have any financial names in it. When we ask a question about how much out of all of the 100 are up in the pre-market, and we can do something like that as well. So we go in and we look at the NASDAQ 100. How many are up at least 1% this morning? 60. That is a very, very bullish sentiment going into the open. On one of those mornings where we are very bullish going into the open, if it wasn't for the Fed on a morning like this, I would be going in and buying options all over the place. Going 1% out of the money, dropping 10 or 12 or $15 and not even care, right? Drop one on American Express, Goldman Sachs, Wells Fargo, Bank of America. I wouldn't even care. It's like throwing darts at a barn wall. You couldn't miss. But on a day like this, even with all this bullishness because of the Fed, I won't go in and do that today. I'm still going to trade. I just won't carpet bomb calls across the sectors. 60 names. So that was the NASDAQ. What about the S&P? 46 names. Now, out of these names, you don't want to try to target one name. You want to scroll through here and see which names are in here and what they represent. Is it electronic technology, finance, retail? We want to look for peer groups. We want to narrow down that list, and it goes back to the sectors. You find the opportunity to trade and narrow down our watch list. Think of a big funnel, and we're trying to weed down these 600 names to maybe 6 really good setups coming into the open. I will be streaming in the large caps this morning, so I will see you all there.